we underestimated how high prices would go. So we wouldn't be surprised to see the prices pull back now. June, July, August is seasonally weak period for investment demand and for fabrication demand, which tends to be reflected in weaker gold prices and silver prices. Not massively weaker, but some consolidation. But then we think that prices go higher in the final 4 months of this year, probably into 2025.
Hello and welcome back to Soar Financially, where we discuss the macro to understand the micro. My name is Kai Hoffman. I'm the EdJR mining guy on Twitter and the CEO of the Soar Financial Group. And today I'm joined by Jeff Christian. He's a managing partner over at the CPM Group. We're here at the SME Current Trends in Mine Finance conference here in New York. And Jeff, it's great to see you in person. I don't think we've ever done an in-person interview.
I don't think we've ever done an in-person interview. We've met, you know, we've been at conferences together, but usually they're remote.
Yeah, absolutely. No, and a lot of Zoom videos and interviews and about current topics, gold and silver price. And I think it's good timing that we're meeting today and we're doing this. Lots going on, of course. And I was watching Bloomberg the last couple of days in the mornings, and all they talked about was gold and copper.
Really?
Right? Not as much silver, but gold and copper. So I was a little worried, is the market overheating? Maybe let's start there. Are other prices for the precious metals and maybe base metals overheating?
Well, yes and no, in our mind. You know, we have been saying for several years that we thought gold and silver and other commodities would rise very sharply into 2024 and into 2025. And our expectations had been that we might see a kind of relatively quiet, first half of 2024 and then heating up in the second half. And we had silver at $32 and higher, and gold at $24 and higher on an intraday basis in the second half of this year. So we're at those prices in the first half of the year. And, so our analysis is, well, is this the peak as we thought it would be in terms of levels, or did we underestimate how high prices would go when things get worse in the second half of 2024? And the bottom line is, our view is, we underestimated how high prices would go. So we wouldn't be surprised to see the prices pull back now. June, July, August is seasonally weak period for investment demand and for fabrication demand, which tends to be reflected in weaker gold prices and silver prices. Not massively weaker, but some consolidation, like 5 to 10% decline over that period. We wouldn't be surprised to see a little bit of a pullback. Some profit taking is already set in. Copper's a special story, but we want to talk about gold and silver. But then we think that prices go higher in the final 4 months of this year, probably into 2025.
Let's talk about those scenarios that are underlying sort of your thesis here. Like, why do you expect that? Is that a recession? Do you expect a recession in the U.S., for example? What would drive prices higher now in the second half of the year?
Well, we're not quite sure what exactly it is. It's some combination of economic, financial, and political concerns. And we're already seeing that. There's this tremendous drive to reduce risk in one's portfolio that's worldwide. People keep saying, who's buying the gold? And the answer is everyone. It's not central bank. Central bank buying is not the major driver in higher gold prices right now. It's really a very generalized move to reduce financial risk and political risk and move away from more risky things into gold and, believe it or not, U.S. Treasuries. I mean, one of the things that people keep saying that's not true is that people around the world are dumping treasuries. People around the world have bought a record number of treasuries. Treasury purchases holdings, offshore treasury purchases holdings rose 10.5% last year to a record $8 trillion. People are racing to reduce risk, and that means dollars, treasuries, gold, silver. And that's what's really going on. And now, so what are the risks? Yes, we think that there's still a recession. I'm on record as saying that my definition of a soft landing is a prolongation of the expansion before the next recession. We are seeing pockets of weakness that are getting stronger in the United States economy and in the European economy, in Japan, in the UK. China obviously has had a lot of issues. It continues to have issues, although last week's move in the real estate market by the central government really is a positive move forward. But China has a lot of other issues. The war in Russia's invasion of Ukraine continues. The war in the Middle East continues. There are a lot of political uncertainties. And one of the themes that we've had for the last 12 months is that in 2024, political risks would probably be much more important than they historically and typically are. And they might even supersede economic and financial risks. But we're seeing financial market instabilities. We're seeing economic weakness grow. We're seeing persistent inflation in a number of countries and a number of segments of economies. So there's a lot of risk out there, and you've got investors saying, I've got to protect myself from this. And that has been pushing gold and silver prices higher. And, you know, yeah, we maybe take a pause for the holidays, but we'll be back.
Well, I saw a statistic of ETF inflows of GLD, for example, was $500 million last week. Another 190 million into GLD, the mini. I don't follow it too closely. That's why I'm not an expert on the ETFs. But when you're saying investors are buying, like, I think we have to define the term investor. Do you throw generalists in there as well?
Yeah, generalists as well. And the ETFs are a very good data point to look at, because when we first, in 1998, we sent a letter to the World Gold Council and said, you keep promoting jewelry, and if you want a higher gold price, you have to promote investment demand. And what you should do is have a gold fund that is publicly listed so people can trade it just like a stock, and that holds allocated gold, and that's the ETF. And he said, now, one of the risks that you will have is publicly traded ETFs have daily reports. This is how much gold was bought and sold on a net basis each day. And people will take that as a surrogate for investment demand for physical gold. It won't be, because the investors in ETFs are different people from people who buy physical gold. And physical gold purchases are secret. You've got to be someone like CPM Group to suss that out. And so no one will know that is. Now, that's all important background, because over the last 3.5 years, you've seen investors buy more physical gold in the physical market, even as they've been reducing their gold holdings in ETFs. So gold holdings in ETFs fell 21, 22, 23.
Just until recently, yeah.
Into and through March, they were falling, right? And it was only in the second half of March when ETF purchases turned positive and you started seeing holdings rise. And I'll get back to that in a second. But what you've seen over the last 3.5 years, take that, because that's the long term and that's what's important. Let's talk about that first. You have seen investors saying, I have to reduce my risk. I have my gold holdings in ETFs. There's counterparty risk there. You know, an ETF share isn't a physical ounce of gold. It's a share in a Channel Island company that's run and managed by financial institutions. I don't want my gold there. I want physical gold that I'm holding on an allocated or unallocated basis. So you've seen people selling their gold ETFs over the last 3.5 years, but more people buying more gold in the physical market. Now, in the second half of March and through April, you've seen a sharp increase in gold prices. There are any number of investors who said, oh man, I got to have exposure to gold. Do I, take a long lunch break and go find a bank or a coin dealer to buy a gold coin? No, I can go on the computer, I can buy an ETF. So you've seen ETF purchases shoot up. Those are short-term investors who are chasing the price higher. And the question is, do they liquidate or do they convert to physical? And you don't convert to physical. You sell your ETFs and then you buy physical. Yeah. Well, you have to mail it in, right?
You can go to Costco and just buy some bullion.
I thought it was only on online orders.
Oh, really? No, I thought you can just go to the store and just pick it up. Yeah. I was curious to ask you, like, what that's like. It's an interesting side story
Yeah.
to it all, because
Yeah.
accessibility to buying gold. You mentioned like, well, you got to walk down here and go find a bullion dealer or so to get access to some physical gold, but you can just walk into a Costco and buy a couple, ounces.
I don't think you can actually. There are a very limited number of ounces that Costco was selling. There might have been a few stores, like 6 stores nationwide, and you could buy them online, and you had to be a U.S. citizen and bring proof of your U.S. citizenship along.
Not sure how that is relevant, but
But it was a good piece of advertising.
Yeah.
The same way as in the peak of the gold market in 1980, Sears Roebuck started selling gold and silver in their stores.
But apparently they're selling $250 million worth of gold.
Yeah.
That's a substantial amount.
Yeah,
Like in the overall scheme of things, probably not, but it's a big number.
Yeah.
Right? Which is not insignificant in my opinion.
And they're getting really nice premium for it.
Yeah. Well, there's always money to be made somewhere, right? We're talking supply. We've talked about during the silver squeeze back in the day. Curious, like where does supply stand? Gold, I'm not too worried about. Let's talk silver, over $32. Do you see any supply changes at all? Is there?
Well, they're short-term and long-term issues, and the long-term issue is that gold at $2,400, and the all-in sustaining costs are probably averaging about $1,500. So you have this enormous profit margin on average, and a lot of that average is skewed to just a few companies. But the reality is that gold and silver mining is very profitable at these levels. So if the prices were to stabilize at these levels, and we don't see it stabilizing at 2,400, but we see gold staying above 1,800, 2,000 on the long run, and we see silver staying above $26, $28 in the long run, and even at $28 an ounce, there's a tremendous amount of mine production that will be developed and come back on stream over the next 5 to 10 years, if the prices stabilize at that level. On a short-term basis, mine production can only do so much in terms of fast response. What you typically have historically seen is scrap recovery, where you'll see people selling their jewelry and their silverware and and silver objects and stuff, and then that gets refined into bullion. And that can back up the refineries. But I haven't heard stories of a lot of that selling going on yet.
Gold at $2,400, silver at $32. Like, let's look at it from the other way. We always talk about the price drivers. What is driving prices higher? But now let's look the other way. Like, what is a $2,400 gold price and a $30 silver price doing the other way around? Like, what is that driving? What are some of the implications or effects from those prices?
Yeah. Well, one is that it will increase long-term supply from mines, because the mines can operate at better levels. On a short-term basis, you might actually see mine production decline, because miners should mine to the average payable grade. And as the price of gold and silver rise, lower grade ore becomes profitable. And if you want to maximize the long-term return on your mine, as the price rises, you lower the average grade of what you're mining. So at this point, a lot of miners will say, okay, let's pull away from some of this higher grade ore body that we're mining and pull out some of the lower grade stuff. So you could actually see some reduction in mine production on a short-term basis. Long-term basis, it should rise. Scrap, like I said, we're just not seeing it, and I think the dynamics of the sell my gold jewelry and silver jewelry when the silver price and gold price rise, I think that dynamic may have changed. We're not, and then on the fabrication side, you will see companies trying to reduce their units. In the jewelry industry, jewelers talk about price points. I'm selling, the vast majority of gold jewelry is actually very low caratage or plated gold, and the price point is about $100, $120 in the United States. It's even lower in the UK. And so as the prices of the gold and silver rise, the jewelers will use less metal per piece in order to make those pieces still in the price range where their consumers want to buy them. So you could see fabrication demand in jewelry, which is the biggest use of gold and silver, fall because of the higher price.
But on a macro side, if you look at the financial markets or so, like what is the ripple effect there from those prices? Because I remember doing interviews like 2 years ago, and I think somebody said, well, if gold goes to $2,000, the US is in a world of hurt. But so now we're at 2,400. Like if you were to look back and say, okay, this is the effect the higher gold price has, maybe the US is in trouble. Like what are the ramifications that way? So I'm curious.
The gold price and silver price are meaningless to the U.S. government and the U.S. economy. Yeah, so gold at $2,000, gold at $2,400 has no negative effect on the U.S. economy per se, or the U.S. government's financial position. Now, the U.S. government has 261 ounces of gold, 261 million ounces of gold. They actually value that at like $42 an ounce on their books, but they know full well what it's actually worth. And everybody who buys treasuries knows what it's worth. So, you know, it's there. And so, you know, a higher gold price is actually positive for the treasury, you know, because they don't own foreign exchange. They own gold. And then silver is relatively meaningless. Yeah.
Okay, interesting. The thought is like Fort Knox, like how much gold does the US own? 8,000 tons?
Yeah.
Somewhere around there, right?
I think in ounces. I mean,
Yeah.
when we start pricing gold in tons, then I'll start thinking in tons.
Yeah.
But it's priced in dollars per ounce. So I think in ounces, and it's 261 million.
Okay, so but it shows up on the balance sheet, right? But if you can re-rate that at 2,400, interesting thought. I haven't really thought about that because the debt to GDP ratio, for example, right? It shows up on the active
There are
side.
people who look at the world in gold-tinted glasses and say, well, the government could solve its debt problem by revaluing its gold. But the government doesn't think that way, and financial markets don't think that way.
I was going to say, what does that mean by revaluing its gold?
Let's
It's
say,
not
okay,
valued at market price.
It's valued at $42 an ounce. Well, let's revalue the gold at $2,400 an ounce, and all of a sudden we have all of this gold that we have a higher value of treasury reserve, dollar value of treasury reserves because we revalued our gold. The financial markets and the U.S. government and pretty much everybody else, except for some gold people, know better than you know, that's meaningless. You know, there's a great time when Hillary Clinton, well, maybe there was never a great time. I've never heard a sentence that started off, there was a great time when Hillary Clinton, anything, sorry. But when Hillary Clinton was Secretary of State and the gold price rose very sharply in 2008, 9, 10, 11, there was a time when she was having a press conference and a reporter said, isn't the dollar de facto backed by the Treasury's gold? And she said, she actually knew the answer. She said, no. She said, if you look at the value of the Treasury's 261 million ounces, and you put it at today's value, and you say, well, let's assume that the U.S. government could sell 261 million ounces of gold at what was then $2,000 an ounce, and it wouldn't, you know, push the price down. That would cover 1/4 of a year's deficit and do nothing to the national debt.
Yeah.
It's meaningless to the national debt. It's meaningless to the deficit. So then the reporter said, so what is holding the dollar up? Because the dollar is doing very well. And she said, the dollar is strong because of the comparative strength of the U.S. economy compared to other major currency countries. You know, we have greater resources, we have a greater industrial base, we have higher productivity, we have a higher educational system. At that time, probably 8 of the top 10 universities in the world were U.S. Now it's down to about 5. You know, but we have, and you know, people swim across the Mediterranean to get to Europe to avoid these repressions that they face, economic, political, religious, in North Africa and in the Middle East. They swim across the Rio Grande to get to the United States to get jobs and to live the American dream. You know, we have this tremendous number of people who want to come here and work hard. They don't want to, you know, come here to get, you know. So she said, you know, so it's the economic base of the United States. It's all of the assets of the U.S. government. And then she said this thing, which is just great. She said, and ultimately, it's the U.S. military. And as she said that, you could see on her face she was saying, like,
did I say that out loud?
yeah, did I say that? I do. I was not supposed to say that in public, but yeah.
It's true. Everybody knows that, right? No, fantastic. Platinum. I wrote that down because I know very little about it. And maybe you can give us a bit of a summary of the market and how it's developing, because platinum, a lot of people associate with catalytic converters. You know, everybody's buying an EV now, apparently. But yeah, I'm exaggerating, of course. But run me a bit through the platinum market. Educate me. I'm curious. Like, I want to learn.
They're right to look at EV or automotive. It's catalytic converters. And if you look at platinum market, for the last, we started using catalytic converters in 1973 for model year 74 cars in the United States. And then Japan brought in catalytic converters in the late 70s, Europe in the late 80s, and the rest of the world, you know, subsequently. And over the last half century, from 1971 until recently, the platinum story was the growth of platinum, palladium, and rhodium demand for autocatalysts. And, you know, autocatalysts went from nothing for rhodium to 90% of fabrication demand. And it went from nothing in platinum and palladium to, you know, 50, 60% of fabrication demand. That's the last half century. The next half century is going to be, we still need platinum, palladium, rhodium because electric vehicles are not going to replace petrol-powered vehicles fast. And I'll get to that in a second. But we will be using less PGMs. So, you know, our long-term platinum, palladium, rhodium study, which we updated last time in December, goes out to 2050. And the title of last year, December's report was the Turning of the Tide. For 50 years, it's been growing auto demand for platinum, palladium, rhodium that's been driving the platinum, palladium, rhodium markets. For the next 50 years, it's going to be falling. It's still going to need it because CPM Group estimates that by 2050, half of the cars in the world, being built and sold in the world, will still be petrol-powered or hybrids, which use petrol power. So you're still going to need those metals for cleaning up hydrocarbon exhaust, not only in motive power, but also in stationary power. You know, the International Energy Agency says in 2050, our major sources of energy will be, number one, petroleum, number two, natural gas, number three, renewables, and number four, coal, having fallen below renewables only after 2040. So we're going to be using hydrocarbons forever. You know, not forever, but for the next half century. But we'll be using less of it, ultimately, and that means that we will be using less PGMs. But we're still going to need them. Now, the imbalance of supply and demand of platinum, because, you know, investors have said, oh, EVs are replacing cars. Why would I need, you know, sell my platinum stocks? And, you know, quite frankly, the platinum companies in South Africa haven't performed very well. And the other major platinum producer is Norilsk in Russia. So you're going to have an imbalance as you have, as the tide goes out. There's going to be imbalances of supply and demand. There's a lot of platinum and palladium above ground. There's not a lot of rhodium, but it is starting to grow because you're starting to see surpluses in newly refined rhodium supply relative to fabrication demand over the last 3 years. But it's going to be a very interesting thing. I don't see platinum and palladium as particularly attractive as investments going forward. But there will be periods of time when you'll probably see prices spike higher as the markets adjust to this new reality.
Okay, no, I appreciate that. It was interesting because I saw you put a video out on platinum as well, right. And it is a precious metal. So I figured I'd ask you about it because I know personally very little about it, right? I haven't really looked into that market. Not too many junior explorers looking for just platinum or PGEs, right? So figured I'd ask you. Appreciate that. You gave a presentation here yesterday as well, Jeff, and I'm curious, like, what were the main key takeaways? What did you want the investors in the audience to take away from it?
Well, it's interesting because my presentation yesterday was actually energy transition and energy metals. And I talked a little bit about it, and I said, you know, the energy transition is going to take a lot longer than a lot of people think. And there's going to be a lot of shifts. There's a tremendous amount of technological uncertainty as well as other types of uncertainties. Solar obviously is there. It's commercially viable. It's using a lot of silver. It will continue to use a lot of silver. Wind power has a lot of NIMBY problems, but it's still a viable thing. Conventional power energy sources will continue to be important for a long period of time. You know, the IEA has 3 scenarios. One is the net zero by 2050. We don't look at that. And the second one is, I'm not sure what they're calling it, APS something. It's the scenario that says that everybody lives up to their pledges at the Paris Agreement.
I'm certainly not looking at that.
And then the one we use is called STEPS, which is the stated principles, stated practices. And it's like, okay, we had the Paris Accord, 16 years ago. And in the ensuing 16 years, governments and corporations have not lived up to their promises.
Yeah.
Let's assume that the trends over the last 16 years continue for the next 25 years. And so that's the steps. You know, this is like, you're not going to get a smoker to stop smoking. You're not going to get me to stop drinking bourbon. I'm sorry. You can have all kinds of studies that say, this is really bad for you, Jeff. And it's like, you know what's bad for me? Being sober when I watch the nightly news. That's really scary. That's bad for my health. So, we use the steps, and you're going to see that transition. So I was talking about that, and I was talking about how you're engineering cobalt out of batteries, and probably you won't be using cobalt in NMC batteries. They won't be NMC batteries within a few years. So the idea of the U.S. government putting money to support cobalt sub-economic cobalt mines does not make sense. Let the market say, no.
A lot of government officials in the room as well. I think.
Yeah.
I'm not sure if it was my first time here at SME, so I'm curious. Like you've been here numerous
I
times.
was very happy to hear the government officials talk about the technological uncertainties that cause significant issues related to where do you deploy federal, public money as well as private money in terms of the energy transition. They express clear knowledge and willingness to pay attention to the fact that, you have no idea. Rare earth elements. Everybody says you need rare earth elements for these magnets, but there's a tremendous amount of research going into what they call iron nitride magnets for motors, which would replace REE. Yeah. So if you're investing in a rare earth mine that's going to be on stream in 10 years, it may not make it.
Yeah, it's like VHS versus, Beta 8 or whatever, the beta tapes. So.
Or VHS versus CDs or DVDs.
And then Blu-rays and or PlayStation versus Xbox is another interesting one. Mm-hmm. Fantastic. No, Jeff, good to see you. Thank you so much for making the time. And where can we find more of your work?
Thanks for having me, and good luck. And
where can we follow you?
Oh, I'm sorry.
CPMGroup.com
is our website. There's a lot of free reports and free videos, as well as information about our reports that you can buy. We will be launching our Silver Yearbook 2024 on Thursday of this week, and you can buy that. It's an ebook. We launched our Gold Yearbook in March, and we'll launch our Platinum Group Metals Yearbook in July. And you can pre-order those ebooks or order those ebooks at cpmgroup.com. And then you can send us emails at info@cpmgroup about what else we might be able to do to help you.
Fantastic. Awesome. Jeff, thank you so much. Everybody else, thank you so much for tuning in here to Soar Financially from the SME Current Trends in Mind Finance Conference in New York. Thank you so much for tuning in. Leave a comment, leave a like. What do you think about the silver situation? What do you think about the gold price move? We want to hear from you. Put that in the comments below, and really appreciate you tuning in. We'll be back with lots more here from New York. Thank you so much for tuning in.